Welcome back to the third module in producing a business plan. Today we're going to be looking at determining what are the financial requirements of a new venture. And these are the module outcomes. All right, let's see, what are the financial requirements of a new venture? Any successful new venture and running business is to keep your finger on the pulse of your cash flow. This will require you being aware of the fact that you need to be monitoring, analyzing, and possibly adjusting your business cash flows all the time. For small businesses, the most vital characteristic of cash flow management is to avoid extended cash shortages, and this obviously can result in a big gap between cash inflows and cash outflows. Identify and explain what are different legal business types of business ownership for new ventures. There are a number of business formations that an entrepreneur may choose with their own business, namely being a sole proprietorship, also known as a sole trader, so you're the only owner. A partnership, obviously you partner with somebody else to start a business. Or a close corporation. These cannot be registered as from the new CIPC requirements, previously CPRO, but currently closed corporations may continue to operate. You might want to be a private company. Under current bill, at the time of writing this material, it's proposed to be called closely held companies. So it's moving away from being known as private companies. Then you have a public company, also known as widely held companies. Then you've got cooperatives, which is another form of business type. Please read pages 67 to 73 in your learner guide about more of these business ventures. All right. When you start a new company, you need to lodge formation documentation with the Companies and Intellectual Property Commission for registration. The New Companies Act of 2008 in South Africa requires the following documents to actually be lodged. Firstly, a notice of incorporation, a memorandum of incorporation, and then also please read pages 74 to 78 in your learner guide for more information regarding these documents. Now, let's determine what are the financial and cash flow requirements of a new venture. Every entrepreneur planning a new venture will face the same problem, calculating actually how much money is necessary to start a business. He or she needs to determine how much the rent or lease, for example, is going to be, pay various licenses, permits, and fees, and has to obviously attain utility services such as water and electricity. A common mistake made by many people is to blindly begin a business without evaluating whether, in fact, it's actually feasible or not. A feasibility evaluation will allow you to make more informed go or no-go decisions. It also involves a detailed examination of what is your financial, personal, and market realities. The importance of finances as part of your business plan. To think of a business idea itself as the first step when starting a business. If you have a feasible business idea and seriously think about starting a business, then you need to actually collect certain information and make plans to see if the new business will be profitable and if you should take that risk to actually start. Structuring your ideas and the information you collect in a systematic manner, but also put it down in writing and translating the ideas into financial sense is called drawing up a business plan. The financial and cash flow requirements of a new venture. First, you're going to need startup costs. So what will you need to actually get the business up and running? Then, running costs. Those are operational day-to-day costs. So what will you need to use to actually, how much money will you need to have the business running from day to day? For example, your water, electricity, rent, and all that. Capital investment costs for growth of business. So we're basically, if you're going to want to grow the business or get new products in, you need capital to invest. Staff costs. How many staff will you be using and how much will you be paying them? Now, in your learner guide, please read more on pages 80 to 87 regarding the financial and cash flow requirements. Here's some of the financial and cash flow planning. Firstly, you're going to have a cash flow, which is obviously the revenue and sales coming into the business, which turns into cash on hand. But unfortunately, as the month goes on, for example, the cash on hand will start to increase based on, for example, cash outflow like cost production, any other costs like day-to-day operations, like, as I said, rent, staff salaries, etc. That is all part of cash outflow. The concept of profit and loss in relation to the financial requirements of a new venture. The most important aim of a business is to make a profit. You can calculate your business's potential to make a profit by listing all your expected expenses and deduct them for your expected income. This is reflected in your statement of comprehensive income, or as they know, an income statement, or a statement of a profit and loss, also referred to as a profit and loss account. This will also show what are the company's revenues and expenses for a given period of time. The concepts of startup capital and working capital in relation to your own business. Startup capital, this is comparatively small amounts of capital contributed at the very beginning of a firm's founder. So basically what you need to start a business. Then you have working capital. Now working capital is sometimes referred to as operating capital and is the valuation of the amount of liquidity a business or organization has for the running and building of the business. So basically, how much cash on hand do you actually have should you actually need to pay for certain expenses. Please also read more on pages 87 to 95 regarding this. Now, let's determine what are the startup requirements and costs according to financial capacity and resources. Starting up costs. The financial analysis process starts with the estimation of funds, which is required to actually start your new venture. The startup costs can be divided into two categories. You have once-off costs, and these expenditures obviously must be made prior to the opening of business, and they are not going to reoccur on a regular basis. For example, if you want to move into a new premises, you might want to paint the walls, or you want to set up maybe a kitchen within the new premises. Those will all be startup once-off costs. Operating expenses, these are expenses required to carry out the daily operations of the business. As I, for example, gave the example of staff costs. If you've got an alarm system that you're going to be paying for on a monthly basis, those are all operating expenses. Now, assets and liabilities. An asset basically simply states assets are those things of value that your company actually owns. The cash in your bank is an actual asset. So the company car that you actually drive is also classified as an asset. Those are objects and also rights and claims owned by and having value to actual firm itself. So they have a resale value. Liabilities. The liabilities are basically the opposite of an asset. And these are obligations to one company to another. For example, if you borrow money, you actually is creating a liability. Accounts payable are liabilities since they represent your company's future duty to pay a vendor. So if you are, for example, taking out a contract for a photostat copier, that is actually a liability. Please complete class activity 3 in your workbook. Moving on, determine the income and expenditure of a new venture. In business, a budget is a forecast or a plan of an organization's income and expenditure for a specific period of time. The purpose of budgeting is to firstly provide a forecast of what is the revenues, income, and expenditures for a business. This also enables the actual financial operation of the business to be measured against what is your forecast. Now, the concept of budgeting. Firstly, it's in the simplest form. A budget is just a list of spending items or incoming revenue items with a budget figure to each of them. As time passes, the actual spending or revenue may be then entered into the budget to compare what did you actually budget for to what was the actual. The difference of the two between the two figures would be called the variance. It's either going to be positive or a negative variance. How budgets apply to your new ventures. Budgets are used to first support funding requests by describing how the funds were used. So, for example, if you need to borrow money from a bank, they would want to know for what purposes will you be using those funds for. To control also spending is also to ensure that the available funds are used according to plan and that spending stays within what is your preset limits. Now, the budget income according to market research and business growth opportunities. Cash sales means all income from a main business activity which is received at the time of sale. Remember that, as well as actual cash received, cash sales can also include your debit and credit card payments, as well as issuing of checks. To prepare your budget, you need to estimate how much income you're going to receive from cash sales, which also includes any VAT if appropriate. To do this, you need to make an estimate of how many specific items you are actually likely to sell, and of course, at what price. And remember, that price would include the profit that you're going to be making. If you're going to sell any related products and accessories, you also need to estimate how many of those you're going to sell, because you don't want to end up with a situation where you have a very good product which sells very quickly and then you run out of stock. There are also other things that you need to consider when you also make your estimates. For example, you need to also take in consideration, do you need to have how much stock on hand? Do you need to order more stock before, for example, a specific period of time? Also, how long will it take for example, the stock that you ordered to be actually delivered? You should also answer the following based on your market research and analysis of growth opportunities. For example, what type of business, location, and the pricing of your new venture. Determine the expenditure of a new venture. Let's say your budget needs to cover the expected expenditure, and there's two types of expenditure items. You've got capital expenses, the capital costs which include the cost of actual building, your equipment and furniture, cars, etc. These are all once-off costs. The running and operating expenses are recurring expenses, and they occur on a monthly or even an annual basis. For example, your TV license, car licenses, tax, etc. And these are the costs of keeping the business running on a day-to-day basis. Now, when you compile a budget, your budget is a tool to use daily in your business, but not as a document you create and then forget about it. You need to closely monitor to see, are you sticking closely to that budget or not? If you don't, you could end up overspending the money that you actually do have in your budget. By using a working budget, you also become more accurate over time and be able to make good decisions about any new venture that you're actually considering. First step when you compile a budget, estimate your maximum number of sales. You should start by looking at maximum sales that you can actually expect. The second step, estimate the local demand and reevaluate your estimate. Contact potential clients and customers either through direct contact or a mail survey to gather market data. The third step, estimate what is the appropriate price for your product or service. Ask questions in your survey about the price that customers are willing to pay and look at how much your actual competitors are actually charging. The fourth step, multiply the price of your product or service by the expected sales. If you have multiple products, perform this calculation for each one and then add up the total. This will give you the estimate of your revenues. So for example, if you know you're going to be selling t-shirts and you're going to be selling them at 10 Rand, you need to say how many t-shirts will you be selling. So if you're going to be selling 100 t-shirts, you multiply the 10 Rand by the 100 t-shirts, and obviously you know you're going to be needing 1,000 Rand for that. The fifth step, estimate the cost of producing or purchasing products that you expect to sell. Also, contact suppliers to get the estimates for materials or products that you will need. Then the sixth step is subtract what is your estimated expenses from your estimated revenues. This will give you your expected revenues for the first year. So that is important because remember the expenses, if they're going to be more than the estimated revenues, then you're going to be running at a loss. Methods for managing and controlling a budget. You use your budget to monitor your income and expenditure to actually see whether or not you actually are on target. It also allows you to report on how you're doing financially to your staff, board, and of course, your investors. Also, it allows you to do what they call cash flow projections. So you can basically project what type of sales you're going to be doing for the next year or so. And it also allows you to make final decisions. And those decisions could be, for example, changing your marketing plan, changing your budgeting, also looking at any other change that might be needed in your business plan. Please complete class activity 4 in your workbook. Implementing pricing and costing principles. Costing is based on the simple principle of recovering your cost. The key principle of costing is to actually calculate the true cost of a product or service, while pricing is determined by demand, market conditions, and factors which will influence pricing such as advertising, promotional activity, and the ability to actually differentiate from competitive or alternative products and services. The costing principles in relation to trading, retailing, manufacturing, and services ventures. If a business has a single product or a service, each unit of which consumes exactly the same amount of a variable cost, then the fixed cost charged to each unit or output is the total fixed cost of the period divided by the number of units sold during that period. Now let's identify the factors that could influence your pricing of your products. In general terms, price is a component of exchange or transaction that will take place between two parties. It also refers to what must be given by the one party, which is the buyer, in order to obtain something offered by another party, which is the seller. These factors that influence pricing include, but are not limited to, wider economic trends, market needs, expenditure, supply pricing, and competition. So obviously, the buyer is wanting to purchase using money, and the supplier or the seller is obviously producing the product. And obviously, they need to then decide what would be a negotiable price for the product. The techniques for pricing and costing. If you look at the techniques for pricing and costing, there needs to be a wider awareness of other trends that could actually influence you. And these are influenced by the following. Looking at the competition. So basically, what are your competitors offering for the same product? Because you want to be as competitive as possible. Also, any economic trends. So based on that is, if, for example, there are trends, for example, where other competitors from other countries are now coming into your market, you need to then consider how much they actually charge in comparison to those trends. What is the need of the market? Does the market actually need your product or not? And can you ask that price based on what does the market need? Expenditure. How much are you actually spending to produce this product and have it delivered? That's a key factor in also looking at your pricing. And of course, that leads to the supplier pricing. If you're having to get suppliers to deliver raw materials to you, how much are they actually charged? Because you need to then pass that cost on to your prospective clients. Utilizing markup in relation to your own new venture. A markup percentage basically is the percentage by which the cost price is marked up. So how much will you increase the price of your of your product? One needs to know what the markup percentage is on the various products or service one sells in order to calculate your selling price. So that obviously you take into consideration is how much would it take to actually produce that actual product itself, and then you need to work out by what percentage would you like to increase that markup percentage. And here's an example. A vendor buys, for example, tomatoes at R1 each. She will sell them for R1.50 each. What is a markup? And there you can see there. The gross profit in rands would be 50 cents over the cost of it, which would be R1. Times by 100, and then you can see she's making a 50% markup. Identifying break-even points for pricing purposes. Break-even is the point at which your sales, your income, is equal to actual costs of expenses. There's no profit and there's no loss. At the break-even sales point, all costs, fixed as well as variable, are covered by the income from the sales. So you're not running at a loss and you're not running at a profit. Once the cost of sales and any other variable costs have been deducted from the sales, the remaining amount is just enough to cover the fixed costs of the business. Revising budgets according to pricing determinations. There are a number of factors that prompt a budget revision. Firstly, poor sales. You sell less than maybe was expected and suspect it may be because your prices are too high. You've identified a number of inappropriate or exorbitant costs and remove those items from the budget. Also, you may feel that the budget is unrealistic and will reduce the budget accordingly. Please complete class activity 5 in your workbook. Identifying resources to obtain startup capital. When you've estimated how much startup capital you need for your business, the next question is, where do you actually go to get that capital? The most important type of startup capital is owner's equity, and this represents the owner's investment in the business. So you might then need to invest money from your own pocket. Loans, we know where loans come from, banks or any other financial institution. Grants, they are non-repayable funds or products dispersed or given by one party, which is your grant makers, often a government department, corporation, foundation, or trust, to recipient, often but not always a non-profit entity or education institution, a business, or an individual. Let's look at what are the various resources required for actually starting a new venture. You need startup capital. This is also known as seed money. This resource would be the initial funding that you will have to borrow in order to start running your business. There will be payroll and its peripheral expenses for you and any other employees, because obviously you need to get paid from the business. Utilities like phone, electricity, internet, communication, etc. Rent, marketing, sales related costs, any suppliers, maintenance, and of course, importantly, is insurance for your business. Banking funding. You might not have enough working capital of your own, and you need to borrow money in order for you to add what you already have. This is also known as borrowings, where you can apply for a loan and have to pay it back at a certain interest rate and possibly within a specific time frame. There's also government funding. South Africa has a good record for helping out new businesses with regards to funding. They sponsored non-repayable grants and assistance programs for manufacturing and tourist-related businesses, as well as innovative R&D product development projects available in South Africa. A grant is an award of a financial assistance in the form of money. There are obviously very strict guidelines for applying and using of these funds. Let's identify the funding options and services offered by financial industries and new ventures. We said borrowing comes from the bank. Entrepreneurial funds are also available, and that comes from the National Youth Development Agency, Department of Trade and Industry, Kula, and TUSA mentorship programs. Now look and see what are the risks associated with funding. To become successful in a new venture and to realize your ideas, you have to know what are the potential risks of starting up funding, but also loopholes of various borrowing options available in the market. The risks are linked to costs. Costs include, but are not limited to, interest on loans, guarantee requirements, collateral requirements. Now the interest on loans, as we know, obviously is going to be could be quite high, so you need to take that into consideration when you do borrow that money to see that you actually can make those repayments. Using of investments, pension or provident fund, those are also risks associated, because you might be using some of the money that you receive from your pension fund to put into your business. And that is obviously a risk, because if that business is not successful, then you could end up losing your pension fund. Credit cards. Yes, the use of credit cards that covers certain expenses of a business. If you are not able to pay back the credit cards, that could also lead to further financial difficulties for you. Releasing of home equity. Bank loans also might not be easy to get. And also taking loans from family or friends. Obviously, that is one of the very last resorts that you actually need to do if you're actually going to be wanting to start up a business. Exploring alternatives to funding options to ensure that all options are covered. Obviously, look at possibly using any of your own savings. Look at what the cash sales coming in to be used to cover the expenses. Loans, banks, government credit schemes, as well as grants. Now, let's compare the costs of various funding options to determine the suitability for your own venture's business structure. Firstly, you need to compare what are the costs of the various funding options that you actually investigated to determine which is suitable for your own business venture. Money, obviously, we know is not free to borrow. People can always find and use for money, so it costs to borrow money. Obviously, you know that's interest. The party who uses or borrows the money from the party who lends them obviously will pay interest. The repayment options. You need to explore what are those repayment options and compare to determine the best options for you. And also you need to consider what would happen if you are not able to make those repayment options. If you look at the simple comparison of what it costs for you to borrow from the various options, you need, for example, to maybe to borrow 10,000 Rand startup money. And then let's see what it would cost if you were to be repaid over 3 years. And there you can see there, for example, family member interest would be interest-free, maybe 10,000 Rand. A friend might charge 10% simple interest. That would maybe increase it to 13,000. And if a credit card at 10% interest compounded annually could increase to 13,310. What information is needed to actually process your funding applications when you want to borrow money? There's always be information needed to process funding applications, and you need to understand the information needed and be able to complete the actual funding application according to what are the business requirements. The various funders will need different amounts of information, with banks and venture capitalists requiring very detailed information, such as the application form, and you can see that example on pages 136 in your learner guide. And remember, when you're applying for these different types of funding, they need to know in detail what is your income and what is your normal day-to-day expenses personally, and also what are the expenses going to be in your business. Please complete class activity 6 in your workbook. Thank you.